This is Joe Gentili from Left Tail Risk Advisors. In today's video, we're going to go through long-term care insurance and particularly long-term care insurance riders to life insurance policies. So long-term care insurance is one of the most important areas of insurance, I think, that people tend to overlook. It's a really unpleasant topic to think about or talk about, so it tends to get put off for people, but it is important. And the purpose of long-term care insurance is to provide a pool of assets that's available to use for extended care events. So if a person becomes chronically ill or they're not able to take care of themselves, either physically or because of cognitive issues, there's a pool of money there to help with their care. And really, that pool of money is to protect two things. So number one, it's to protect the person that needs the care. It's to protect their family. The person that needs the care is going to get the care one way or the other in all likelihood. Either they're going to deplete their assets and go to Medicaid, or more likely their family is going to step in and provide that care directly. That's a problem because usually the person's spouse or their children, if they step in and provide the care, this is something that's just it forces them to completely reorder their life and change their life. So this is something that people understandably do not want to put on their family members because it's a really life-changing event to be put in that situation where you're providing the care. Along those lines, for the person that needs the care and for their spouse, long-term care insurance protects their retirement income. So in the event somebody needs care, it's very, very expensive. And if it's not being provided directly by family, if it's home health care or if it's in a facility and the person's paying out of pocket, it's going to meaningfully reduce their assets. And in retirement, assets is really the equivalent of income because that's where most people derive their retirement income. So if the person needs care, it impacts their lifestyle because now, in addition to paying everything they normally pay for, they're going to have to pay thousands of dollars extra a month for their care and for their surviving spouses in the event they pass, who now has to deal with a much reduced asset base to draw income from. So, very, very useful and I think necessary piece of insurance for people to have. Traditionally, people have gotten that through standalone long-term care insurance, and that's developed a bad rap over the years for a couple of reasons. Number one, when these products were created initially, they were mispriced. They were priced too inexpensively. Insurance companies, this was a new risk for them to price at the time, and they just got it wrong. So what happened with that is that the insurance companies were forced to raise the cost of insurance on people to keep the policies. So what started out as one price, in some cases, the cost of insurance for those folks doubled or even more. So that was a nasty surprise. The other aspect of it is people did not or do not like the use it or lose it nature of standalone long-term care insurance. So you could pay premiums for years. If you happen to die early and not have a need for any extended care, then it's a lose it scenario, kind of like car insurance if you never get into a car accident. So the insurance industry innovated to deal with that, and they innovated to deal with that through riders to life insurance policies and to annuities. And these come in a few different flavors. So I'm going to start with life insurance for the basic chassis. So the first way people can address the long-term care or extended care risk is through what's considered a chronic illness rider. These are, let's say that they are the least expensive way to address it, but they provide the least amount of protection as well. The reason why they provide the least amount of protection is because over time, the long-term care market has become highly regulated and standardized. This way of dealing with it, of accessing the death benefit in a life insurance policy early through a chronic care rider, is not nearly as regulated. So what um, triggers the ability to tap the money, what the care will cover, all of that is um, very different depending on the chronic care rider with the company that you have. So it's a little hard to tell just how good those are. So they're less reliable. Next is a long-term care rider. So it operates very similar, that this is a rider that you put on a life insurance policy where in the event that you need long-term care or extended care and you meet the criteria, and again, you're going by the standard criteria now for long-term care insurance, this is much more predictable, you're able to access the death benefit early. So these riders have a cost attached to them, but they're great because it allows you, if you have let's say, a whole life policy and you have a death benefit, you now have two uses for that life insurance policy. You have it to provide a legacy or to provide the standard, uses of a death benefit for life insurance. You could tap your cash value early through loans, but now you could also, through this rider, um, you could tap into the death benefit if you meet the standards for long-term care. And so there's 6 activities of daily living. If you can't do 2 of them, or you have cognitive impairments to a certain level, you could get the death benefit early. And finally, the version of it that provides the most protection amongst the life insurance riders is where you get into a long-term care hybrid policy. And these policies have, in addition to the death benefit on the life insurance, in the event you need long-term care, you have a separate additional pool of money that can be used to cover a long-term care need. So, the policy may have a $100,000 death benefit. Most people, almost everybody, does not buy those policies for the purpose of the death benefit. The death benefit operates as a version of like a return of premium, where if you don't have a long-term care need, at least your family is going to get something. It's not going to be a loss for of buying the policy. So, you may have $100,000 death benefit, but maybe you have $400,000 to tap for long-term care needs. So these policies have that additional pool of money in addition to the death benefit. So it's true long-term care insurance in that way. And it's not use it or lose it, because you can get funds returned in the event you don't use it through a death benefit. And also what these policies provide is that, unlike the standalone long-term care, you could have guarantees in place for how much the policy costs. So you could pay off a policy early with a long-term care rider, or one of these hybrid long-term care policies where you could pay it off and not have to worry about getting premium increases down the line. So that's also very useful and provides people comfort. Of course, over time, these policies are more expensive than a standalone long-term care policy, but you do get that dual use of making sure that death benefits paid out if you don't use the long-term care insurance, and you get the extra comfort of knowing that there's not going to be premium increases down the line. There's a similar structure available on annuities. There's long-term care hybrid annuities where you could have a pool of money available as an annuity, an income stream, and there could be additional money available if there's a extended care or long-term care need. So very similar to the life insurance hybrids, but put on an annuity. And these can be very useful for people that already own an annuity, where they could exchange the annuity that they have into one of these annuities with a long-term care hybrid attached to it, and they're able to get some tax benefits by, if there's an event that they have a long-term care payout, though that payout can be tax-free. So it could be a way to tap annuity money without having to pay taxes when it's paid out. It also has a different underwriting standard than life insurance, so there may be some people for which life insurance underwriting is not favorable for them, but annuity underwriting may be. So that's my basic primer on the different types of long-term care insurance that's available. If you have any questions, feel free to reach out to me. Happy to talk about it further. And if this was useful, I encourage you to subscribe for future videos. Thanks. Bye.